Hello, everyone. Thank you for joining us today. My name is Stéphanie Émond, and I'm the Director of Impact and Operations at FinDev Canada, Canada's development finance institution. We were established in 2018 to provide financial solutions to the private sector in emerging and frontier markets in order to combat climate change, create jobs, and advance women's economic empowerment. I have the privilege today to speak with Karen Karniol-Tambour, the head of investment research at Bridgewater Associates, one of the most influential investment management firms today, renowned for its unique culture of radical truth and radical transparency. A Princeton graduate, Karen joined Bridgewater in 2006. She currently oversees a team of 150 investment professionals, researching and building strategies for investing globally. Branded as an idea generator, Karen has established herself as an expert on global markets, as well as an advocate for advancing women's leadership in finance. Karen, it's a real pleasure to have you here with us today.
It's a pleasure to be here, Stephanie, and be speaking with you.
So we're here to discuss one of the defining challenges of our time, economic inequality. Whether measured through the gaps in household income or wealth, the disparities continue to widen. While some countries have experienced declining income inequality, in the US and in most countries around the world, wealth concentration has spiked over the last decades, and the gap is growing, underpinned by pervasive, unequal access to education, to healthcare, and to finance. So, Karen, why would the largest hedge fund in the world care about wealth inequality?
Thank you, Stephanie. It's a great question. And what I would say is that the most important thing as an investor is very basically to understand the world, to understand what are the big dynamics, what is happening, and what is likely to drive markets. And it's easy to talk about the big macroeconomic conditions, but they feel to us very lacking without also looking at the social conditions and these issues of wealth and income inequality in particular. And so we're at this place in the world now where, we're 10 years after a financial crisis. Interest rates have been zero for a decade. There's been a lot of quantitative easing, and quantitative easing disproportionately affected asset owners, people who held assets like stocks and bonds, who are wealthier people generally. And now we have a downturn, a largest downturn we've had since the post-war period on our hands. And the only plausible way to make a dent in it is a new kind of policy. It involves both monetary policy and fiscal policy, printing money, but also having government direct that money to those who really need it. And so you could look at that kind of macro backdrop on its own, biggest downturn, the need for a new policy, but you'll be missing some of the most important dynamics in it if you don't look at the background of decades of building tensions, building social tensions within the wealthy countries, because those tensions have translated to populism in some places, to political dysfunction, polarization, right at the time where we're more reliant than ever on our political system to be delivering through fiscal policy and addressing these issues. And if you only look at sort of classic macroeconomic conditions, you really miss what has not been going right in these societies and therefore what is affecting markets. So in our view, it's basically impossible to be a macroeconomic investor today and not be looking at issues of wealth inequality with a real concern and with the question of whether or not capitalism can be made more sustainable and whether or not our political system can drive towards changing these realities and delivering the kind of impact they need to deliver, given that big macroeconomic backdrop where fiscal policy is more necessary than ever.
So let's talk a little bit about, public policy and fiscal policy in particular. Are you Have you seen recently some changes in certain markets and fiscal policy that, in your view, address income or wealth inequality in a good way? And maybe let me flip it another way. What would you recommend to policymakers who, want to meaningfully address this issue?
Well, I think that the fact that the COVID crisis has been an inequality increasing event, if you just take COVID as it's occurred without intervening, naturally, those least able to work from home are people on the lower end of the income spectrum. You have a big difference between men and women, with women being much more expected and likely to stay home, take care of children, deal with the fact that there are ongoing school closures, and the starting health conditions, especially in a place like the United States, of people lower on the income and wealth scale are significantly weaker. And we know that pre-existing health conditions make a very big difference to how people respond to COVID if they do get it. And so you basically have a crisis on our hands that, without intervening, exacerbates inequality in a major way. Poorer people less likely to work from home, more likely to need to go out and put themselves at risk, more likely to have the health conditions that make them more likely to get sick, big difference between men and women. And in our view, public policy has stepped in a pretty significant way across a lot of countries. Obviously, there are differences across countries, but in the United States, fiscal policy, well, we don't know if it'll be extended, has been quite effective at directing money that's printed very directly to those who need it, who have been much more people, and call it the bottom 60 or 80% of households, really undoing a lot of the inequality increasing effects of the crisis. The main question is, will it continue? Will there be enough of an impetus for this to continue? I think that the most interesting analogy to today is probably the 30s and 40s, where in the 1930s and 1940s, you had the same situation where monetary policy on its own could no longer be effective. You needed both fiscal authorities and money printing to work together. And it took a large shift in kind of the public's perception of the role of government to be able to get that done. And that did happen in terms of issues that at the time addressed social conditions and wealth inequality in the form of things like the New Deal. But it also happened for much more unfortunate reasons because of external tensions. The fact that there was a world war. And so there was public consensus that it was government's role to step in and, address the world war that was going on. And so you had huge government spending that stimulated the economy to handle the war. And today's conditions are very analogous in many ways because you have both the internal tensions that are leading to increasing consensus that it's government's role to step in and address these inequalities and address the social tensions that have arisen. But you also have increasing external tensions, especially between the U.S. and China, a rising power and an established power that could also lead to consensus that is where public policy should be focused, which would, of course, be a very different direction and could take the world in a much worse direction.
So the title of our session is Investing for Good. I'll use the expression impact investing, that is, investing with the intent to have a positive impact on environmental and social issues, like wealth disparities. Do you think this type of investment and investing can play a role in closing the inequality gap?
Well, I think there's a huge shift in investor perspective from what you just described. And it's very exciting because I almost think about it as you go from a two-dimensional focus, saying, I'm an investor, I care about risk and return, saying, actually, there's a whole third dimension, which is impact. And suddenly you start saying, I want to achieve my risk and return targets, but I also want to achieve impact targets. I also care about where my capital is going. And that's a huge shift, and it's very exciting. And, where Bridgewater has really been focused as a firm that works with very large institutional investors is mostly proving that it can be done, proving that if you have that goal and if you want your capital allocated to entities that you really believe are going to contribute to making a difference in the world, can it be done at scale without paying a price on your return and risk objectives in a way that really speaks to your whole portfolio? And, our brief answer is yes, the same principles that of sound investing that let you build a diversified, reliable portfolio can be applied to assets that also have that third dimension impact goal, which means that investors actually can contribute in making sure that their asset allocation, their capital that is going out into the world is going to entities that they believe will make a difference.
And so what does it, I love that idea of a three multi-dimensional and that seeing the world of investing in 3D. It's still pretty niche. And it's amazing to hear you say that you're excited about more and more of your investors looking to place capital in a more sustainable way. But what will it take for impact investing to really emerge as a mainstream asset class?
So two things I would say. One is that investors that are large institutional investors care about their investments being scalable and standard. So anything that can only be done by having lots of expertise and a very small amount of money put to work kind of gets stuck. So a few years ago, every time we talked about impact investing, it was always, I'm very excited about one investment I'm making, but it's a tiny, tiny, tiny percentage of my capital allocation. And it takes me a lot of effort to get that done. And the real potential to make this mainstream is for policymakers as well as market makers to help create more standardization, more, indices, derivative contracts, ways to make these assets more liquid, more scalable, easier to access without quite that depth of expertise, securitizing more pieces together. So as an example, you don't have to be an expert in one sector in Ecuador to make an investment there. You can buy a pool that has a combination of assets, all of which are going to purposes that you want to pursue without knowing everything but every project. That's really how every scalable investing, has gotten quote unquote mainstream, just the ease of accessing it. And right now we're early in those stages. There's still a lot of debates about what the right standards are. And a lot of the best assets we see have not really been made yet to be, kind of liquid and easy to access. The second thing I would say is there's a huge role for policymakers. Being at the place where we are, where fiscal policy really will have to be a lot more active, and that's being well understood. Investors have to look at what policymakers are doing and seeing what is the direction and kind of setting up the playing field for what will be attractive. To be blunt, if policymakers set it up that it's extremely attractive to invest in coal, they're going to have people invest in coal. Whereas if policymakers set it up that the incentives are there and public money is coming alongside private money to invest in things that contribute more positively to the world, then there will be demand behind there from investors that are following the world, seeing how it's evolving and want to be part of that.
So, COVID-19, governments are really focused on that. Big concern is, managing their fiscal space. They're racking up debt. They'll be thinking jobs, jobs, jobs. Climate change, of course, as well. But, are you worried that the current situation will maybe place a damper on this opportunity for investing more sustainably?
I actually think that this situation is more likely to accelerate it than anything, because if there wasn't a downturn, there wouldn't be this great need for government to be spending money to get us out of the downturn. And with the fact this downturn has occurred, there's this great opportunity where it's understood the government needs to spend. And the question is on what? And in many countries, the emerging consensus of what the mandate of government is and what they should spend on are things that really further social goals. They really connect to understanding that people don't really just care about GDP in the classic sense. That it used to be that, when you come out of poverty, GDP is a pretty good sense of well-being getting better and better. But if you look at the last 20, 30 years in richer countries, not a very good measure, because quality of jobs matters, quality of pollution matters, people care about the future of their children, people care about the quality of their health care. And so that gives government a big mandate to spend in these directions at a time when it's needed because of COVID. The second issue is, I actually think that the fact that COVID was hard to predict, meaning even if you were an expert in pandemics. You wouldn't say, this is the most likely thing to happen is that you're going to get this global pandemic that'll spread in this way and shut down the world in the way that it did. That was a possibility, but it was, kind of one of many possibilities. And that I actually think that helps galvanize an understanding that risks like climate change should not be studied just from a central scenario, that we have to think about what's the broad range of possibilities, and that something that might be just, 20% likely to happen if the world warms could still be a very, very large concern to worry about. And that can actually galvanize a lot of action relative to its feeling a little bit more theoretical in some of the kind of worst case scenarios before COVID.
So FinDev Canada invests in emerging and frontier markets with a view to contribute to the Sustainable Development Goals or the global goals. And it's clear that we cannot achieve them without private investors joining us. But, frankly, we're hard pressed to find institutional investors to invest alongside us in frontier markets. Karen, what will it take to get large investment houses to invest for impact in frontier markets, in your view?
I would go back to the same point on standardization and removing the need to have the expertise that you, for example, have at FinDev Canada. So you have tremendous expertise at FinDev Canada in a lot of specific emerging markets. And some of these frontier markets, large investment houses are not necessarily going to have that level of expertise. And so, for example, the role of the large multinational development banks, places like the World Bank, and saying, can we have private investors take more risk, but we'll at least help pool the risk and make it so you're not only investing in one small project where you have to have expertise. The role of market makers in saying, can we create a product that pools a lot of these structures together and makes it so you don't have to be such an expert in every project. That is what can really unlock the capital, in my view, because otherwise you just can't rely on every investor to build expertise at that level. And if you compare it to, for example, simple comparison, how people invest in corporate bonds, many people invest in corporate bond indices without feeling like they need the expertise in every single company because that liquidity and that standardization has been created.
So I read somewhere that you keep a big list of your current research projects. And so are there a few items on that list that address some of the topics that we've talked about today, and any research or research projects that you'd like others, including someone like FinDev Canada, to maybe dive deeper in?
Well, it is definitely, so it is true. I always do have a big list of our research projects, and it is a very exciting time for any research agenda because so much is happening in the world and shifting quickly. But I would say that, a major topic that we're grappling with, closely related to what you and I have been discussing today, is basically how will the social tensions and inequalities and so on end up making their way into the policy discussion and therefore markets. And so, for example, looking very closely at issues like when the Federal Reserve shifts its mandates and is talking about questions of whether or not it cares about the quality of jobs or the access of jobs to certain women or minority groups, how will that end up impacting policy now that that's on the agenda? So we're seeing these issues come on the agenda in many places. I'd say that last year we studied in depth what before COVID was this huge divergence between great looking macroeconomic conditions at the high level and deteriorating social conditions in many countries. And so now that broad macroeconomic conditions have, of course, deteriorated as well, how do we have a recovery that doesn't just bring us back to where we were? How does that make its way into the agenda and therefore into markets? How's that literally going to occur? That is definitely a major research topic and issue. And the second one related to what we've been talking about is how will these fiscal agendas go? The fiscal agendas are so huge, bigger than they've been in many, many years. What are actually their effects going to be? And so if a government says, I'm going to supplement the incomes of, the most vulnerable households? Are they actually going to succeed in doing that? Will they actually receive the money? Will it go where it's supposed to go? Will it go into the economy? How will households respond to the fact that it's not money they're guaranteed to keep forever? The checks might run out. They might not renew the program. It's very different psychologically to have a job and be working versus be receiving money from the government. So understanding how all of that is going to work, especially where these lofty social goals are being employed, but what will actually be productive and make a big difference in the economy and the markets is a major research topic as well.
So time is going by so quickly. I'd love to hear you, maybe a more personal take about, your own experience. The investment sector is not recognized as being particularly diverse and inclusive. Thankfully, there are more and more leaders like yourself who demonstrate that things are changing. Are you optimistic about how the industry is evolving, both in terms of its own internal practices and as well as in managing its assets?
I'm very optimistic. I mean, to be honest, even the fact that you, Stephanie, are interviewing me and you've had the career that you've had and you're doing the role that you had, and that we have this panel where the two of us are speaking, to me, the industry looks radically different than when I joined it, 15 years ago. I see a lot more women role models. I see a lot of women I've mentored over the years get to much higher positions and make a big difference at Bridgewater and elsewhere. I see some of our alumni, that were part of our community and mentored through the years make a huge difference in other parts of the industry. And I think the most important trend is the deeper realization from both men and women of what their roles are, because it's very, very important for women to play their role in terms of both being mentors and honestly, kind of being there as someone to look at as a role model, because I know I had spent a lot of my career trying to figure out, who can I look to? What could that be like? And there are a lot more role models I looked at today. And then for men, I think that their role in mentoring women and deciding in a time where often there are no women in their area, that they're going to make some of their successors women, that they're going to take women they see talent in. And even though their career doesn't feel kind of intuitively like the career they went through, that they see real potential there. I see a lot more men doing that in a serious way. I can say for me personally, since you asked about my personal experience, we have 3 Bridgewater chief investment officers, Ray Dalio, Greg Jensen, and Bob Prince. Each one of them invested so much in me and mentored me in such a personal way. And more than anything, often believed in me more than I would have even believed in myself, and saying, I really believe that you're capable. And that made all the difference. And so seeing that around the industry and seeing it, for me, feels like bearing fruits relative to 15 years ago. We have a ways to go, but I think we are making good progress, and that there's realization from men and women that they're stakeholders in that process.
Yeah. Well, Karen, it's been amazing to speak with you today, and we're very lucky to have you as an outstanding role model. Thank you for your valuable insights today, and I look forward to our next conversation. Thank you, everyone. Thanks for joining us.
Thank you so much, Stephanie.